The magnificent 7 stocks of the S&P 500 played a pivotal role last week in stabilizing the market. However, it is crucial to recognize some shifts that are underway, which could potentially disrupt the financial markets. And instead of overwhelming you with narratives, we're going to be focusing on essential levels that you should be monitoring, whether you are both bullish and or bearish on today's stock market brief. If you're new here, welcome to the channel. We use technical analysis and intramarket analysis to get a good idea as to where the market might be headed next. We got a lot to discuss, so let's just go ahead and get right into it. Welcome back, people. Okay, so we're going to take a look here at week-to-date performance, and what you notice is we got some green on the screen. Couple things, okay? SPY was basically unchanged, but the Qs, right, the Magnificent Seven really did hold things together. Russell 2000 took a big hit, 2% to the downside, a little bit off of its lows, and the Dow Jones remained unchanged there too as well. You'll notice here that the 10-year yield did finish higher on the week, putting pressure on these indices, and you'll notice here the dollar too as well finished rather flat on a week-to-date basis looking at the UUP. And then you'll see equal weight Qs, right? So the equal weight was rather unchanged too. So it's really the cap-weighted Big 7 that's really holding this market together. You can see that even more here if you look at the equal weight S&P 500 was down. Banking sector, right? Regional banks down. And then financials also was a lead weight there too as well, holding the markets down. If you look at the 11 sectors that make up the S&P 500 from a week-to-date perspective, technology was the leader. And then down there towards the bottom are the names that have been getting, that are very rate sensitive, that have been getting hit as the yields have been rising, such as real estate, utilities, and consumer staples. Energy did get hit, but that's coming off some very overbought conditions. Now, I want to focus here on a couple of things. The most important market, or most important chart really in this market, is looking at bonds and looking at yields. And I'm just going to use TLT here as the proxy, but despite seeing the market rally, take a look here how TLT finished down on the day, 1.21%, and down on the week. But it is interesting to note that on the last day of the week, as we saw the markets really start to rally, which we were been preparing for, you'll notice that the 10-year yield was up alongside of that, which is a little bit concerning. So we just need to be aware of that taking place. If you take a look at TLT, this market has been completely collapsing, and we've been paying attention to this 70 to 80 range here where we saw prior resistance and prior support. But let me just show you something that's very, it's just incredible to see just the magnitude of this, looking at it from an unadjusted, right? This price right here is with dividends, right? So it's looking at that, but to see a more raw price of the TLT, take a look here as I unadjusted the chart. And what you'll notice here is we're sitting at around this 85 level. And if you just look to the left of the chart, we haven't been down here, well, since 2007, right? Since the great financial crisis in 2006. We had 2004 over here, and then 2001. This is when, as far as I can go back for the TLT, so probably when the ETF came about. And you'll notice that from an unadjusted basis, we are basically at the lows. So to say that this isn't a big deal, is just beyond belief to say that. This is a gigantic move that's taking place in the bond market and should not be ignored. You'll take a look at TNX, how we watched this break out in this channel. This how it pulled back into the channel and started ripping up higher, but it's kind of been on this parabolic type move, trajectory, right? So we kind of, we're in this channel, as we kind of discussed, and what you'll notice is we started kind of like making this parabolic run up, and we created a shooting star candle here. So our rate's going to go press us higher, which could continue to put pressure on the markets. And we've even seen it where rates fall off, right? And the Fed, steps in, does something where rates and the markets can fall down simultaneously. If we take a look at the TNX, you can see here we're not too far off of that 5% as we've been on this just parabolic run up in recent trade. Now, I want to show you this chart because this really kind of depicts of, something typically breaks, and this creates opportunities to individuals that are prepared for it. And there's a lot of stuff going on in this chart, so I'm going to walk you through it, okay? This is the federal funds rate, and this is Russell 2000 on a weekly basis. So this chart, Russell 2000, and the reason why I'm showing the Russell 2000 is because it is a good barometer on the economy, right? There's a lot of small businesses. This one has a lot of smaller energy names, smaller bank names, smaller companies, Okay, so when this is going up, typically, the economy could be in a place where it's thriving. And when I'll put the Fed funds rate down here, you'll notice something, that when the stock goes up or when the ETF rises, it's been rising in an environment when what? When rates are down to zero. So what does that mean? Okay, so you have zero down here, you have 5% up here, which is roughly where we're at, right? Basically what this means is as the rates are down, this is the Federal Reserve loosening the money supply, right? So this is where money's cheaper, right? And people typically spend more money, even money that they don't have, because it's easier to accumulate money or borrow money at a cheaper cost. Okay, to say it, I guess, in a very simplistic way. And when rates go up, this is encouraging people to, well, tighten their belt, right? This is where money becomes more expensive. It's harder. It's more expensive to buy a home, more expensive to buy a car. And the reason why is because payments typically go up. Rates are going up. And as you'll notice, rates are obviously at a higher point. We're in a rate cycle. Okay. Now, what you'll also notice is there's typically this breaking point at some point where, hey, rates are high, we start to flatten, and all of a sudden we smash it back down to zero. Okay, everything's going fine, we start to raise, but then we smash it back down to zero. We raise it, right, and we're supposedly holding higher for longer. And what you'll notice here on this chart down here is I'm showing you times where the 10-year and 2-year yield curve has been inverted and uninverted. And you'll notice that if you line it up with the federal funds rate, which I've shown this many times, there's even a small inversion right here, and then we're basically right here where we're still, we're moving out of inverted. This last week we made some movements towards that, but we're still inverted. What you'll notice is when it uninverts, right, you'll notice that typically that's when actually price action starts to get a little bit more volatile. Now I have added another element here called the RVX. This is Russell Volatility. And you'll notice that during periods of times of these inversions, okay, when we're uninverted and then we start moving back up, you'll see that the Russell Volatility typically moves through this period of contraction. And then all of a sudden, right, we get a, snap type of move where we get this parabolic boom, boom, rise. And that has happened, shortly after inversion, boom, we spiked. Shortly after inversion, boom, we spiked. And I wanted to just call this out because we're in a very similar area to how we were over here, right? To how we are over here as well. We're in a rate hiking cycle, holding rates higher for longer. Volatility has been contracting, and you can see that because volatility spiked, boom, we're putting in lower highs right here, and we're getting a little bit tighter. So it leads me to believe that saying, hey, if we start uninverting, that's one of the signs, but is that the best time to potentially buy? Well, no, based off of this chart, you have federal funds rate down typically lower, and that's when things start to kind of go on this parabolic rise. Not to say that's always going to happen, but that has what happened there in the past. If I look at the IWM from a weekly basis too, you'll notice that while volatility is contracting in these areas, you'll see that price action was contracting too. And what we have going on right now is, a period of contraction. We moved down, expansion, and then we're starting to contract here and get a little bit tighter. All right. So volatility is contracting, price action is contracting. We have the federal funds rate at a higher point, and we have the yield curve uninverting. So when the yield curve uninverts, like I said, not shortly thereafter, we've seen some pretty large spikes in volatility. And that, when we see the spike in volatility, take a look at what rates are doing. That's when we get the spike, that's when our indication that the Fed might be moving rates significantly down or making a big movement to the downside. So that is something that I'd say pay very close attention to, because it seems like, hey, when something breaks and volatility spikes, perhaps when we get uninverted, this could open the door for good opportunity for the next bull run in something like small caps and various other names too as well. Another big important asset to watch is the dollar. We've been watching this from an intermarket standpoint, so just as important, right? Bonds, the dollar, these are intermarket assets that you want to continue to watch. And as the dollar has been rising, it's been putting pressure on assets like gold, various commodities, and the S&P 500, right? When the dollar broke down, what happened to the S&P 500? Well, we started rising. Well, what's going on here? The dollar has been on this run, right? And then the S&P 500 has been falling. It wasn't too long ago when we were falling right here, and so many people were saying it's the end of the dollar. Well, the dollar reversed, boom, and now people are saying the dollar can continue to go higher. We'll continue to watch it because we are kind of just on this very, tight, very algorithmic type move to the upside. And if this channel breaks, perhaps we're going to go through a period of consolidation, perhaps ease up the markets where we can see, maybe some of these Magnificent Seven stocks, hold the market together, or we start to see a flood into some other various names. Now, if I take a look from a week-to-date perspective on the S&P 100 of the top performers, you'll really see here, okay, Google, right? NVDA, Google, right? So G-O-O-G and G-O-O-G-L, Meta, AMD, Tesla, right? And then so forth down the list, right? We have Apple, Microsoft, right? The big Magnificent Seven, those were the big gainers on the week. So when these names perform really well, obviously it holds up that S&P 500. But on the flip side, there was also some very interesting stuff taking place, right? When the bonds have been crashing, things like real estate has been getting hit, utilities have been getting hit, consumer staples have been getting hit, and we're talking not small moves. These have been gigantic, outsized moves in typically lower beta names that are showing volatility of some high beta names, right? So look at NEE, Nextera Energy, that was down 12% on the week. XOM, right, that took a big breather, that was down 8%. That's an energy name. MDLZ, Mondelez, that was down almost 9%. McDonald's, down 6% on the week. PepsiCo, down 5.4%. Coca-Cola, down 5%. Target, 5% down. These are huge. Verizon, I mean, come on, that is a low beta name. That thing was down 4.81% on the week. Okay, so pretty impressive outsized moves here. And then we have stuff like COP, which is another energy name, but we have a couple banking names there too as well that you'd want to pay attention to because we do have earnings coming up very soon. And if I show you some of these charts just to show you how big these moves are right now, look, you have a huge move to the downside. We kind of came back on the last trading day. So perhaps, right, this bullish outside candle, perhaps we get a little bit of relief or a bounce. XOM, right, we're pulling back where? Well, we broke out, right? We broke out, back tested, ran up, and now we're kind of pulling back into this area. But look at this, 121 to 105. You can't tell me that that's not a very volatile move in these markets. Mondelez, look at these candles. These candles right here on a consumer staple product. These are huge outsized moves on big volume taking place. McDonald's, I mean, holy moly, this chart was looking really good right here. I was talking about it saying, hey, yeah, look for a break above 300. We had a volatility, contracting here, right? We expanded, we came down, we started contracting, getting tight, no breakout, but guess what? We went through a period of expansion to the downside as RSI is getting pretty fried over there too. Take a look at Target hitting another 52-week low. This thing has been getting hit very, very hard. So we're floating around that 100 area. A lot of these names could present themselves to be great opportunities for longer term or value investors in the near future. But just be aware that, hey, this might not be the capitulation. We might see a severe capitulation to really, freak people out. And clearly we're in a downtrend. So it takes a while for these type of names to heal. But it doesn't mean that there aren't opportunities to say, hey, we bounce right back up to 115, right? So 105 to 115, that's $10 a share. That's a pretty dang good move in a very short, could be potentially short period of time. Take a look here at Walmart. That was a gigantic move to the downside, 152, but well off the lows. But that is a huge candle on Walmart. So a big break there through the 50-day moving average down to around the 200-day on some large volume too. So clearly something big has been happening. Even Costco was looking very bullish here. We had this little, contraction, inverse head and shoulders kind of pattern base. But then we had this big crack on the prior day, well off the lows. So it's still within this consolidation, but it's just something to just be very mindful of. As we're moving into earnings season, we have coming up next week, PepsiCo, right? BlackRock, Wells Fargo, Citigroup, JPM, right? United Healthcare or United Health. I forget exactly the name of this company, UNH, but a big healthcare company in the S&P 100 that's reporting in this next week too. And then we have a lot of macro data, right? So we have PPI coming out. We have FOMC minutes on Wednesday. We have a bunch of Fed talk, right, earlier in the week. And then Thursday, we get inflation data. That's the 12th. And then the following day, we get, more Fed speak and then also consumer sentiment. All right. So there's a lot of stuff going on in the markets, a lot of interesting charts that I just went over, including, unadjusted TLT bonds, and then also the IWM, the Russell 2000, maybe something to watch for if something breaks, because these things, like I said, they can present themselves to be opportunities down the road. It doesn't mean you need to act right now, right? But I'm putting this in front of you because, it could very well be great opportunities down the road. Now, I want to hop into the Magnificent Seven, right? These names have really been helping the market out this last week, but it doesn't mean we're just out of the water as the 10-year yield has been rising. So this could very well just be a short covering rally and it gets faded. So we need to know some levels. So I'm going to go through this quick and I'll have a chart deck that you can download. It's going to be part of the pinned comments. That's also, if you want more information about my Patreon/Discord group, and then also the brokerage that I use to do my swing trading, okay, which is Interactive Brokers. There's links to all of that right there in the pinned comment. So the key levels that I'm watching here, I'm just going to go, like I said, through it fast so you can just download the chart for completely free. It's a PDF and you'll see these levels more closely. But you'll notice here I have the quarter to date anchored VWAP and price actions above it. So if price action starts getting below it, or this 173.50 on Apple, I mean, I would say watch out, right? Because we're starting to use this area, right, as a prior area of support, and then we consolidated, got tight, and we started breaking from it. So it's bullish, right, in the short term, but if we start cracking back down from these levels, well, that opens the door to start heading lower. And then potential resistances, gap fills, and then also this red line up here where we had this gap down, right, act as resistance. It tried to hold up, and then we broke down here with some bigger volume, right, and that kind of flushed it. So that 187.38 there. If we take a look at Microsoft, take a look at how price action coiled up, right? These offer the best opportunities in my opinion, right? So price action, it moves through expansion and contraction. And look at how price action coiled up, right? It got really tight. We talked about that on the last video on the SPY, saying get ready to rumble, and we broke above the high, and we saw this explosive move. Now, why is this such a good trade, right? Despite it being in this somewhat of a downtrend, the reason why it's good is because if it breaks out and you have this tight period consolidation, you have very defined risk. So even if it breaks out here, right, and it goes up and stops you out at an ideal place, which would be like right around here, okay, you take a small loss. But if you do move through a period of expansion where it really starts taking off, I mean, take a look here, how this thing broke up to almost around that upper trend line there. So that's Microsoft for you. Google, this was also, we had an inside trading day. We broke above it and we went to retest the prior high. So 138, a break above that. This is a pretty strong move. So I just be careful to, not to just chase it blindly, right? As we moved into these areas before, we saw some flushes. We had areas of supply. So you'd want to hold above that or consolidate some more to potentially break higher. And then if we start breaking down, we had prior areas of support and resistance. So that 127, I will round it 127 for a period, an area of support. So if we start breaking down that level, that could be, not the greatest look for Google. NVIDIA, same thing, right? We contracted here, right? Right around that 440. The 440 acted as resistance. It acted as support. We got hung up at right here. We gapped above it. We had some choppy trade throughout it. We flushed into it. We gapped down, we came back up to it, and then we flushed back down. So this 440 in NVIDIA is a key level that if we start breaking down from this and the quarter-to-day anchored VWAP, watch out. But as it stands, we broke out, right? We've closed it around the high. So this at least opens the door to try this prior area right at around 460, a few dollars higher to 465. And then if we keep rolling, take a look at 480.88, and you can just see here, there is the possibility of a head and shoulders topping pattern forming. But overall, I mean, it was a pretty strong day, or a very strong day for NVIDIA. Take a look at Tesla over here. Tesla, we had a gap down into where? That quarter-to-day anchored VWAP. I've showed this chart before. The last time I shared this chart was actually on this day. So if you want to look at this, whatever date that was exactly, September 18th, we talked about how it was kind of a bearish flag and how it pulled into a larger time frame area of resistance. Well, I just wanted to call out that we broke down and we're starting to see a little bit of a bounce. So if we get back underneath the quarter-to-day anchored VWAP, right, or break down from this flag, that could spell a little bit more trouble there. But overall, if we start moving higher, take a look at 279.50 and then this gap fill right over here as a potential area of resistance. Take a look at Amazon. So Amazon has been getting hit down, but we've kind of been trying to find its base right around this 124 level. So I say, as we had a strong day here, bullish engulfing candle, back above the quarter-to-day anchored VWAP, maybe not the time to chase, but if we can hold this 124, it at least opens the door to come fill this gap, okay, or this prior swing high. That's how I would be looking at this. If we pull back, cool, you might be able to find a re-entry on an intraday time frame, but have a stop, within, the low of this swing low, or right at around that, just under 124, because if we start closing underneath that, it opens the door to continue this trend, right? You see this, expansion, contraction. If we break above it, great. But if we start breaking back down below it, watch out. and take a look at Meta. This was one that I personally traded. This is one that I did share with the Discord group too. I mean, price action was just coiling up here, and this one was in bullish context, which I like to see, right? So we had to move up. We pulled back, right? It doesn't really offer up a trade, but then price action started tightening up, as you can see there. But then it got even tighter right here, where we had an inside trading candle. We're right above the quarter to date. We said if it basically breaks out, it's on breakout watch. I would like to see a higher volume breakout. We did see increasing volume on that breakout, but it wasn't anything big, especially when you look back to the left and you see these pockets of red volume on the down days that are way more above average. So if we start breaking back down through this level, obviously watch out, because it can come test the lower trend line or potentially be a bold trap, right? People come and chase it, and so forth. The potential target that I'm looking at right now is just the swing high as it stands, which is 326.20. This was an outsized move, so perhaps we get some sort of inside day, or perhaps it is just a one-time fake out, boom. But even if it is, you can have a stop at break even or take partial profits at this point, right? And then have a stop down here where it's a break even trade, because this thing was just like the other, Big 7 was just a rocket ship. Now let's take a look at the S&P 500. So S&P 500 finished up slightly on the week, as we discussed, but it was all the way down here at 42.20, which just so happened to be the lower weekly expected move, just about right there. I would say that, with a $4,000+ product, if it comes within a few bucks, you basically are tagging it. And that's what the options market implied as risk going into this last week. And I will update you on those levels momentarily. Now, we are still disconnected from a declining 5-period EMA, okay? And we said, be careful when we're below it and we're, haven't reconnected, because you can get snapbacks. And that goes from the upside, snapping back, the downside, snapping back. And we got to the downside, we got pretty extended from it, right? I'd say more than 2 standard deviations from the weekly 5 EMA. And we snapped back pretty hard. So come next week, this will probably come down a little bit more. Look for a potential reconnect for the weekly 5 EMA, as it is declining. So the trend here is currently down from that perspective. Now, if I look at the daily time frame, I want to just point out this specific candle. It's an outside trading candle. It's a bullish engulfing candle, how this big green body captured the body over at the prior candle. We said if it broke down from the low, look for a flush to the prior lows. It did that. It came in with this low. I don't think it quite tagged this low, but it came very close. We said if it breaks above it, right, start to play it to this high or potentially higher. And this thing screamed when we broke above it. So hopefully you caught some gains there on that reversal as we held that year-to-date anchored view up. But this bullish engulfing candle, is this going to mark a reversal like the one we talked about right here, right? So this candle is a bearish engulfing candle, a bearish outside trading day, and it marked the 2023 high. And since that point, we started moving down, right? We had another bearish engulfing candle, but that didn't matter because we came back up and so forth, and then we started breaking down. So a level that I want to pay attention to from if we start continuing to move up over time from the daily perspective, I want to look at this gap fill over here, okay? And then also the potential resistance at 443. And the reason why is because you can see it was acting as resistance, price got hung up at it, got hung up at it again, and then we had to gap over it to start getting some momentum. And you can see we came right back into it, then we saw an aggressive flush, kind of bounced back into it, aggressive flush. You can see it held as support, and then we had aggressive flush. So this 443 here is like some magnetic level as we've seen in the past. You can even see that it broke down from this kind of head and shoulders pattern, and it could very well be just trying to come back test the neckline as it stands. But we are still above that year-to-date anchored view up and the quarter-to-date. So if you are bullish, this makes sense, but you might not want to, and if you missed it, you might not want to trade, and I'll tell you why when we get tactical in the 15-minute time frame. But if we start breaking below the low and the low of the year-to-date anchored view up, that opens the door to be obviously more cautious. So it's a good sign. There are some things obviously taking place that we previously discussed to be aware of, but now we know the key levels here to pay attention to. Now, if you want to take a look at the new expected moves for the weekly time frame on the S&P 500, they're going to be the orange lines. And then I put the gamma exposure levels going into this next trading day. One thing that I'm just calling out here is we tagged here, we tagged here, we tagged here, and we bounced from these levels at the lower channel support. This also happens to be the area where we had the fear and greed index be at extreme fear. Okay, and we usually bounce on these levels. So to see a bounce potentially up to the upper weekly expected move, people get very excited, everything changes, narratives change, perhaps even higher to 4,500. The world's coming back to normal, but it might just be tagging this upper trend line, and you never know what happens after that point. So we need to be tactical and ready for these, face melt up rallies that can potentially happen. Now, I want to get tactical because we saw an aggressive move, and it does not necessarily mean that you just blindly enter. It all depends on your time frame and how you approach the markets as far as risk goes. So this is the SPY on the 15-minute time frame, and I wanted to just call out the purple line. The purple line has been declining, and what we like to do is wait for this to start flattening out if you want to be more of a bullish trader, because when it's declining and price action's below it, right, it's telling us that the short-term trend is down. And as you can see, it's been down this area. So if you got out while it started flattening out and breaking down, say even right here, you just basically save yourself a lot of time within the chop and the decline. But now, as price action started to get more constructive, it starts to flatten out. So going into tomorrow's trading session on Monday, we have, right, 1 day. It's going to start here, 2, 3, 4, and then 5, and we start losing this data. So this data is going to go into the calculation for the 5-day moving average, which on this time frame is 130 period SMA. So as it stands, this is starting to flatten out to level up as long as price action can hold above. We had a nice big move, and I don't like to chase these type of moves, right? Price moves between expansion and contraction. So you wait to see, hey, if price can pull back, where would be an area of interest of potential support? Well, we had support here, prior resistance. And we also have this volume profile you can see here. And sometimes when we get outsized moves from it, these volume nodes can act as potential magnets. So watch for price action to potentially pull back into this area. That doesn't necessarily mean buy it right away. What it means is wait to see if it gets constructive or flags out, and then you see the series of higher highs and higher lows where you can buy into that strength to catch the trend, right? It's not going to just be one straight line up. You always have periods of consolidation and things to watch out for. It's you sometimes get strong moves, but then you get chopped back and forth, and then you have a strong move, you get chopped back and forth, strong move, bounces and so forth. And this was a period of consolidation here, and we held. Now, like I said, if you want to be more bearish, right, it would be more under the 421 or back below the 5D period moving average. So as this turns up and we consolidate, maybe we go outsized a little bit more, whatever. Perhaps we go like this and then we consolidate up here. Perfect, okay? Whether you buy it here or here, right here would be the better area from a risk to reward standpoint, because if you enter here to chase it and it goes up and you're like, yay, but then it comes back down here, well, then you're stuck here within this money and you need price to make its way back up. So it's always good to watch for the contraction. Gives you a tight risk to reward. You're in a bullish context, and then you say if you play the breakout right over here, you have a stop here, or you can even have a partial stop here, and so forth, and play it a little bit more tactically, more strategically. Now, going into tomorrow's trading session, we have new weekly expected moves and daily expected moves for SPY. So the daily is in white. Boom, boom. That's 432 to the upside, 426 to the downside, and then we have the weekly expected moves here. So like I said, if you want those numbers specifically, make sure you download the chart deck, which, once again, it's free. I just upload it to SlideShare. Take a look at IWM. We had this kind of accumulation. It looks like a Wyckoff accumulation pattern over here. We did get above the 5 DMA, but you can see that it is still declining as it stands. So if we start pulling back, look at this prior area of resistance. Once resistance is broken, it can become support. So perhaps a pull back into the 5 DMA and see if price action shows strength after that fact. Or, right, see if price consolidates more here. And then we start breaking out above that 174 to get a pop to maybe this volume node right at around 176.50. The Qs had what's known as a diamond pattern, and diamond patterns, it's just a technical pattern. It shows, volatility. It went, got contracted, then it expanded, then it contracted again. And just a simple way to measure this using technical analysis is taking the low and the high and then measuring it from the low or from the breakout area, the same measurement, right? Boom. And where would that take us? Well, that would take us to around that 369 to 371 zone, which happens to be, this air pocket of volume right over here, and then price action where it acted as resistance. So that would make sense for a potential target here on the Qs from the shorter time frame, but that doesn't necessarily mean chase this move, right? You could get lucky, right? If you buy it right here, or say if we open here tomorrow and then we get another outsized move, cool, great. But just pay attention to how, it's already a big move. So the risk could be a period where we kind of pull back, go like this, and then you're like, I'm going to get out. And then all of a sudden, then we start showing strength and then moving up, and then you get flushed out of a position. So it's always important to just watch how price contracts on the smaller time frames. But as we're above it, right, the 5-day moving average is starting to flatten out to go up now. So if price starts pulling back, perhaps to around this 361 to 363 kind of zone in here, and it holds, and we start basing out, and then we start seeing strength, then I can say, okay, you can potentially buy right there with a stop under it, or trailing the 5-DMA to play up into this area, or even to a gap fill or potentially higher. Really quickly, a couple indicators. We're still in oversold conditions on a lot of different indicators. So I don't want to, beat this, to the ground and keep going over every single video. But the NASDAQ composite, the bullish percent index, the RSI is pretty fried over here as it's starting to turn up. And then the summation index is still negative territory, well below zero, and it's still pointing down. However, we've been talking about the positive divergence building in the NASDAQ McClellan oscillator, and we just kind of tagged into positive territory there as we started to bounce. So price action put in a lower low. The internals were saying the other taking the other side of that story, saying we're strengthening, and we're starting to see that bounce come into fruition. Whether that holds true or not, we will see. But as it stands right now, we saw some bullish activity take place on Friday, right? So some bullish price action, constructive price action, not necessarily something you want to necessarily chase into, but we discussed where you can potentially watch price pull down to. And then part of the big seven, we discussed obviously very key levels of interest from a support and resistance standpoint, that if we start breaking, just beware that the S&P 500 might just be, might be seeing just a quick kind of, rip your face off type of move. And then all of a sudden we start reverting back down. And that's, how you get tricked in these type of markets, including in very volatile negative gamma environments. That's all I got for you on today's show, everybody. It was a lot. I'll see you guys on the next episode. Bye.